The market does not usually take money from bad traders first. It takes money from impatient traders. That sounds strange because most people believe success in trading comes from finding more opportunities, more charts, more entries, more action. But what if the problem is the opposite? What if the market is not asking you to trade more, but to trade less? Look at your own behavior for a moment. How many times have you opened a chart and felt uncomfortable doing nothing? How many trades were placed because you saw an opportunity? And how many were placed because you simply wanted movement? There is a difference, and that difference quietly drains accounts. The market creates a peculiar kind of pressure. Nothing is physically forcing you to act, yet you feel pushed. Candles move. Prices jump. Someone else posts a winning trade. Suddenly your mind begins to whisper, "Don't miss this." But miss what exactly? Because here is something traders learn slowly: movement and opportunity are not the same thing. The market moves every day. Real opportunities do not appear every day. Those are different realities. Most losses begin before the entry button is pressed. They start in the mind. A trader becomes bored, and boredom creates curiosity. Curiosity turns into prediction. Prediction turns into justification. Then the trade appears almost as a formality. See the chain reaction. One small emotional shift creates an entirely different decision. Now you may ask, if waiting is so important, then what exactly are we waiting for? Not perfection. Traders misunderstand that word. A perfect trade is not a magical setup where risk disappears. It is a moment where conditions align with your rules so clearly that conflict disappears. You are not convincing yourself to take it. You are recognizing it. Think about this. Have you ever entered a trade while arguing with yourself? Maybe this level holds. Maybe volume comes in. Maybe buyers step up. Notice the language. Too many maybes. Strong trades often feel different, not because they guarantee success, but because they remove unnecessary questions. So what should you actually look for? Watch for price behavior that confirms your idea instead of merely supporting your hope. Watch how markets react around important levels. Does price reject with strength? Does momentum follow through? Are buyers defending areas, or are they hesitating? And equally important, what should you avoid? Avoid forcing patterns because you are tired of waiting. Avoid taking average setups simply because nothing better arrived. Average trades create average decisions, and average decisions slowly train the mind to accept lower standards. This is where patience becomes practical, not philosophical. You are not waiting because waiting feels noble. You are waiting because every trade you avoid protects energy, focus, and capital for the trade that actually deserves them. Most traders believe the important moments happen when they enter a trade. They believe success lives inside the click of a button, inside the timing of an entry, inside the excitement of catching a move. But many of the decisions that shape a trader are made before any position exists at all. They are made during the silence. And that silence is uncomfortable, isn't it? Open a chart and watch what happens when nothing is setting up. The market moves, candles form, prices rise and fall, and yet there is no clear reason to act. A strange feeling starts to appear. You begin checking another chart, then another one. You zoom in. You zoom out. Suddenly a pattern that looked ordinary a few minutes ago starts looking interesting. Have you noticed how quickly the mind starts creating opportunities when there aren't any? That is what makes the space between setups dangerous. Not because the market becomes unpredictable, but because your mind becomes active. The market can stay quiet, but your thoughts usually don't. Silence has a way of exposing things. It reveals impatience. It reveals the need to feel productive. It reveals how much a trader depends on action to feel involved. Think about it carefully. Why do traders force entries? Is it always because they see something valuable? Or is it because sitting still feels like wasting time? Many traders confuse activity with progress. They believe staring at charts for hours should produce trades, as if effort automatically deserves reward. But markets do not operate that way. The market owes nothing for your attention, your time, or your effort. You can spend 8 hours studying charts and receive no trade at all. And sometimes that is a successful day. Because every market environment has a personality. Some days price behaves with direction and purpose. Other days it behaves like noise wearing the disguise of opportunity. The problem is that noise often looks attractive at first glance. Price moves slightly higher. You think momentum is building. Then it pulls back. Another candle appears and gives hope again. Your mind starts connecting pieces that may not even belong together. Why? Because the human mind dislikes empty space. It wants stories. It wants reasons. It wants certainty where none exists. A trader sitting in silence begins filling the gaps with assumptions. And assumptions are dangerous because they slowly turn wishes into decisions. Watch what happens inside your own thinking. A setup starts with, "I'll wait for confirmation." Then after enough time passes, it changes into, "This looks close enough." Close enough. Those two words have damaged more accounts than traders realize. Because standards rarely disappear all at once. They erode quietly. One compromise becomes normal, then another compromise follows. Eventually a trader starts taking positions that would have been ignored a month earlier. The market didn't change. The trader changed. So what should you watch during these quiet periods? Watch your own reactions more than the charts. Do you feel restless? Do you feel pressure to participate? Are you beginning to create reasons instead of observing facts? Are you looking at price action, or are you looking for relief from boredom? Because the space between setups is never empty. Something is always happening there. While price appears inactive, habits are being built. Discipline is being tested. Standards are either becoming stronger or weaker. The market moves every day. Prices rise, prices fall, candles expand, news appears, momentum shifts. If movement alone created wealth, nearly every trader would succeed. Yet most traders eventually discover something confusing. They can watch the market all day, see endless activity, and still walk away with nothing except unnecessary trades. Because movement and opportunity are not the same thing. At first, that sounds obvious. But watch how people actually behave. A candle suddenly accelerates, and attention immediately follows it. Price breaks higher and traders begin feeling urgency. A sharp drop appears and fear enters the room. Something is moving, so the mind automatically assumes something important is happening. But is it? Ask yourself a simple question. How many times have you entered a trade because price was moving fast, only to watch that movement disappear a few minutes later? How many times did excitement make something look stronger than it actually was? Speed has a strange effect on perception. Fast movement creates emotion, and emotion changes judgment. When traders see rapid movement, they often feel they are seeing opportunity leave without them. The mind starts producing pressure. Get in now. Don't miss this. You're late already. Notice what happens next. Instead of observing, you begin chasing. Instead of waiting for confirmation, you begin predicting. Instead of asking whether conditions match your plan, you start asking how quickly you can participate. One small emotional shift changes everything. The market understands something many traders don't. Movement attracts attention. Sharp price action pulls people toward it the way bright lights pull attention in a dark room. That is why so many traders become trapped inside random volatility. Because movement creates a feeling of importance, even when no real opportunity exists. Imagine standing beside a busy road. Cars are constantly moving. Some move fast, some slow down, some suddenly change direction. There is constant activity. But would you step into traffic simply because things are moving? Of course not. You would wait for the right moment. Trading is no different. Yet traders often forget this once money enters the picture. Real opportunities usually carry something beyond movement. They carry structure. They carry context. They carry evidence. Price may approach an important level and react with strength. Buyers may repeatedly defend an area. Momentum may build while volume supports the move. Conditions begin aligning instead of merely creating noise. And that creates a very different feeling. Have you noticed that the strongest setups often do not require much convincing? You are not forcing reasons together. You are not saying, maybe this happens and maybe that follows. The picture begins making sense on its own. Weak trades usually need stories. Strong trades usually need observation. This is where many traders lose money without realizing it. They begin rewarding movement itself. Every active chart becomes a potential trade. Every sudden move becomes a signal. Eventually, the brain starts connecting action with opportunity, even when the connection does not exist. And habits work exactly like that. Repeat something often enough, and the mind accepts it as normal. So the next time price starts running and urgency begins building inside you, ask a different question. Do I see movement? Or do I see opportunity? Because one creates excitement. Most traders think losses come from bad analysis. They believe the chart was misunderstood, the timing was wrong, or the market simply behaved unexpectedly. Sometimes that happens, but many losses begin much earlier, in a place most people barely notice. They begin with forced action, and forced action rarely announces itself clearly. No trader sits down and says, "Today I want to take unnecessary trades." It happens quietly. You watch the market for a while. Nothing meaningful appears. Time passes. Minutes become hours. Then a feeling begins to grow. You know that feeling, don't you? You start thinking, "I've been here long enough. Something should happen by now." Suddenly the mind shifts from observation to searching. Then searching becomes reaching, and reaching changes how you see the market. A chart that looked average 30 minutes ago starts looking interesting. A weak setup begins appearing stronger. Small signals become larger in your mind. You start connecting pieces together because you want a reason to act. Notice the sequence. First comes impatience. Then comes interpretation. Then comes action. The trade itself is usually the final step, not the first mistake. This is why forced trades are dangerous. They do not happen because you lose control completely. They happen because your standards slowly move lower without you noticing. Think about a person bargaining with themselves. Maybe support holds here. Momentum could continue. The market looks ready. Pay attention to the language. Could, maybe, looks. Uncertainty itself is normal in trading. No trade offers guarantees. But there is a difference between accepting uncertainty and manufacturing confidence. Forced action often creates fake certainty. The trader starts collecting evidence that supports a desired decision while quietly ignoring information that disagrees. It becomes less about reading the market and more about getting permission to enter. Have you ever noticed how easy it becomes to justify a trade when you are tired of waiting? That is because the mind wants relief. Waiting creates tension. Human beings naturally want to resolve tension. A trade feels like relief because it gives the mind something to do, even if the decision is poor, even if the risk is unnecessary. Activity creates temporary comfort, and temporary comfort can become expensive because every forced trade creates consequences beyond money. People often focus only on the financial cost, but there is another cost quietly building underneath. Habits. Every unnecessary trade trains behavior. Every compromise setup teaches the mind what is acceptable. Repeated enough times and lower standards stop feeling wrong. That is how discipline disappears. Not through one dramatic mistake, through repeated small decisions that seem harmless at the time. A trader takes one average setup. Nothing terrible happens. Then another follows. Then another. Eventually average starts feeling normal. Then something interesting happens. The market finally presents a high-quality opportunity, but now the trader is mentally exhausted. Capital has already been used. Focus has already been drained. Confidence has already been shaken by unnecessary positions. The real opportunity arrives, and the trader is no longer prepared to see it. Because forced action creates a chain reaction. One unnecessary decision changes the next decision. Then the next one. Many traders believe confidence means feeling certain before entering a trade. They think confidence is that strong internal feeling that says, "This trade is going to work." So they search for it constantly. More indicators, more confirmations, more opinions, more analysis. They keep adding pieces because they think enough information will eventually remove doubt. But something interesting happens. The more they search for certainty, the more uncertain they become. Have you noticed that? You look at one chart and feel ready. Then you check another time frame. Suddenly questions appear. Then you read market opinions. One person sees strength, another sees weakness. You search for one final reason to feel comfortable, but now the picture looks more complicated than before. The problem is not the lack of information. The problem is internal conflict. And many traders don't even realize they are carrying it. Internal conflict happens when your actions and your rules stop moving together. One part of you wants discipline. Another part wants opportunity. One side wants patience. The other side fears missing out. Now you have two different voices making decisions. And once that happens, trading becomes heavy. Because every trade starts feeling like an argument. You enter and immediately wonder if you made a mistake. Price moves slightly against you, and doubt grows. Price moves slightly in your favor, and fear suddenly appears. You want profits quickly because you never fully trusted the trade in the first place. Does that sound familiar? Notice how much energy gets wasted there. The market itself already contains uncertainty. There is no reason to add personal conflict on top of it. Strong trades often feel different, and many traders misunderstand why. It is not because they guarantee success. It is not because risk disappears. It is because the decision itself becomes cleaner. You are not trying to convince yourself. You are recognizing something. There is a difference. Imagine standing at a road crossing and seeing traffic coming from every direction. You hesitate because signals conflict. Move forward or stay back. The uncertainty creates tension. Now imagine the road is clear. You still look carefully because risk exists, but there is no argument happening inside your head. Trading works the same way. When your rules, your observations, and market behavior align, mental friction becomes smaller. Not absent, smaller. You still understand that losses happen. You still accept uncertainty. But you are no longer entering based on hope or emotion. You are entering because conditions match your process. That matters more than most traders realize, because internal conflict changes behavior after entry too. A trader who enters without conviction often manages the trade emotionally. Stops get moved. Exits become random. Decisions become reactions rather than planned responses. Why? Because uncertainty before the trade usually becomes instability during the trade. The mind seeks comfort once pressure appears. This is why traders sometimes exit winning trades too early and hold losing trades too long. The problem was not only the market. The problem existed before the trade even started. So the next time you prepare to enter a position, pause for a moment and ask yourself something simple. Am I seeing what is actually there, or am I trying to persuade myself into action? Most traders chase precision before they learn patience. They become obsessed with perfect entries, exact levels, tight stops, and flawless timing. They stare at charts trying to catch every small movement because they believe success comes from entering at the perfect second. At first, that idea sounds reasonable. After all, better timing should create better trades, right? But look carefully at what often happens. A trader spends hours searching for the ideal entry point. Price gets close but not close enough. They wait a little longer. Then price begins moving without them. Suddenly patience disappears, urgency arrives, and they jump in emotionally. Have you seen that happen before? A person who spent 30 minutes trying to be precise suddenly abandons all precision within 10 seconds. Why? Because many traders are not really searching for accuracy. They are searching for control. And control is seductive because the market constantly reminds you of how little certainty exists. No matter how skilled you become, risk remains. Losses remain. Unpredictability remains. So the mind naturally tries to compensate. It starts believing that if the entry becomes perfect enough, uncertainty will shrink. But trading does not work that way. Because precision without patience creates a dangerous habit. It trains traders to focus on tiny details while ignoring larger conditions. Imagine trying to plant seeds in bad soil while worrying about placing each seed at the perfect angle. The precision itself may look impressive, but the foundation underneath is weak. Markets are no different. A beautiful entry inside a poor setup is still a poor trade. This is why patience often matters before precision. Patience allows conditions to reveal themselves. It allows market behavior to develop. It creates distance between observation and action. Without that space, decisions become rushed. And rushed decisions often disguise themselves as smart decisions. Watch how traders behave around anticipation. Price approaches a resistance level. The trader already believes a breakout is coming, so they enter early. Price approaches support. They assume buyers will defend it, so they enter before confirmation appears. They tell themselves they are being precise. But are they? Or are they simply trying to get ahead of something that has not happened yet? Because there is an important difference between preparation and anticipation. Preparation says, if this happens, I will act. Anticipation says, I think this will happen, so I will act now. One waits for evidence. The other waits for hope to become reality, and hope has a way of changing what people see. Have you ever looked back at an old trade and wondered why you entered at all? Later the mistake seems obvious. The setup looks weak, the signals look incomplete. Yet in the moment it felt reasonable. That happens because urgency narrows vision. When people become impatient, they begin focusing only on information that supports immediate action. Everything else fades into the background. Patience slows that process down. It creates room for questions. Does price actually confirm the idea? Is momentum behaving the way it should? Are buyers and sellers showing commitment? Or am I simply expecting them to? Because strong trades rarely demand speed from you. Strong trades usually become clearer with time. And traders who learn this stop asking one question above everything else. How can I enter perfectly? Most traders spend their time trying to force clarity out of the market. They zoom into smaller time frames, add more indicators, watch every candle, and search for signals hidden inside every movement. They believe if they study hard enough, the market will eventually reveal exactly what comes next. But markets rarely work that way. The market does not always speak clearly. Sometimes it hesitates. Sometimes it sends mixed messages. Sometimes it moves in ways that create more questions than answers. And that is where many traders begin making mistakes. Because uncertainty feels uncomfortable, doesn't it? You open a chart and price moves up, then down, then back up again. Support appears important for a moment, then suddenly weakens. Momentum begins building, then disappears. Nothing feels stable. But instead of accepting uncertainty, many traders start trying to solve it. They begin filling empty spaces with assumptions. Maybe buyers are accumulating. Maybe smart money is entering. Maybe the breakout just needs more time. Notice something important here. The market itself did not say these things. The trader did. There is a difference between observing information and inventing explanations. And once traders start inventing explanations, confusion often becomes disguised as confidence. Have you ever looked at a chart and felt mentally exhausted after staring at it too long? At first the setup looked unclear. Then after enough time passed, you suddenly convinced yourself that everything made sense. But did the market become clearer? Or did your mind simply become tired of uncertainty? Because human beings naturally want patterns. We want stories. We want order. Randomness creates discomfort, so the brain immediately starts trying to organize it. That instinct works well in many parts of life. Trading can punish it, because markets sometimes require patience more than interpretation. Then something interesting happens. Eventually there are moments when the market stops speaking in whispers. Price approaches a key area and responds decisively. Momentum begins showing commitment instead of hesitation. Buyers defend levels repeatedly. Sellers lose control in visible ways. Now the picture begins changing. You are no longer forcing pieces together. You are no longer guessing. You are no longer trying to create meaning. The market starts providing it, and you can feel the difference. Strong opportunities often carry a strange simplicity. Not because they are easy, and not because they guarantee success, but because unnecessary confusion begins disappearing. Have you noticed how certain trades seem obvious after they already happen? People often think that clarity only exists in hindsight, but that is not entirely true. Real opportunities often leave footprints before they move. Price behavior starts aligning. Reactions become more meaningful. Momentum starts supporting structure rather than fighting against it. The signs are there. The problem is that many traders never see them because they become too busy listening to noise. Imagine trying to hear one voice in a crowded room. If every person is speaking at the same time, everything blends together. Nothing stands out. Then suddenly the room becomes quiet. Now one voice becomes easy to recognize. Markets behave in similar ways. The clearest signals often do not arrive through more activity. They arrive through less confusion. And traders who understand this begin changing the questions they ask themselves. Instead of asking, "How can I make sense of this market?" many traders believe they are only participating in the market when they hold a position. If they are not buying or selling, they feel inactive, unproductive, left behind. The strange part is that this belief quietly creates some of the worst decisions in trading, because doing nothing is still a decision, and often it is the most profitable one available. Think about how difficult that feels at first. You sit in front of the screen watching prices move while your hands remain still. Candles form. Momentum appears for a moment, then disappears. Other traders post gains. Someone catches a move you ignored. Immediately a question starts forming in the mind. Should I have taken that? That question alone has trapped countless traders. Not because curiosity is dangerous, but because it slowly turns observation into regret, and regret creates pressure to participate. The market understands human behavior better than most people realize. It constantly creates movement, knowing that movement attracts emotion. Fear of missing out does not come from logic. It comes from watching opportunity appear to belong to someone else. But appearance and reality are rarely the same in trading. You may see another trader posting profits from a random move. What you do not see is the risk they ignored, the inconsistency behind the trade, or the losses surrounding that single moment. Yet your mind compares your silence to their action, and silence begins feeling wrong. Have you noticed how quickly people become uncomfortable when nothing is happening? A trader watches the market for an hour without entering a position, then 2 hours. Eventually the mind starts searching for reasons to trade, not because conditions improved, but because inactivity begins feeling unnatural. This is where discipline quietly breaks down, not through recklessness, through discomfort, because waiting requires emotional control that action temporarily removes. Entering a trade creates relief. Suddenly you are involved again. Now there is something to monitor, something to hope for, something to react to. The position gives the mind occupation, even if the trade itself is weak. That is why many traders overtrade after long periods of inactivity. They mistake emotional discomfort for market opportunity. But experienced traders eventually understand something important. Cash is also a position. Waiting is also a position. Staying out of weak conditions is not passive behavior. It is active protection. Imagine a professional hunter walking through a forest. Does he fire at every sound in the distance, every movement in the trees? Of course not. He understands that reacting to everything destroys focus and wastes resources. So he waits. Not because he lacks skill, because he respects timing. Trading demands the same mindset. The market does not reward constant participation. In fact, constant participation often creates emotional exhaustion. The more unnecessary trades a person takes, the harder it becomes to recognize quality when it finally appears. Why? Because attention becomes scattered. Confidence weakens. Capital shrinks. Emotional stability erodes. One poor trade rarely stays isolated. It affects the next decision, and the next one after that. This is why protecting yourself from mediocre opportunities matters so much. Every trade you avoid leaves you stronger for the moment that actually deserves your attention. Strong traders understand this deeply. They do not measure productivity by how many positions they take. They measure it by how well they preserve clarity. And sometimes the clearest decision in the market is the one where nothing is entered at all. Many traders stay busy all day and still make no real progress. They watch charts from morning until night, jump between time frames, react to every move, enter multiple positions, read opinions, follow news, and constantly feel involved with the market. At the end of the day, they feel exhausted, and strangely, that exhaustion often feels productive. But being busy and being profitable are not the same thing. In fact, they often pull traders in opposite directions. Think about how most people approach work in normal life. More effort usually creates better results. Work longer hours, complete more tasks, stay active, and progress tends to follow. Trading can reverse that logic completely, because the market does not reward effort in a direct way. It rewards judgment, and judgment becomes weaker when the mind is overloaded. Have you ever noticed how decision quality changes after staring at charts too long? At first you are patient. Objective. Careful. Then after hours of watching movement, your thinking slowly changes. Every small move starts looking important. Every candle feels meaningful. You begin reacting instead of observing. That is not increased focus. That is mental fatigue disguised as engagement. Busy traders often fall into a dangerous cycle. They believe constant activity keeps them sharp, but constant stimulation usually creates emotional noise. The more information they consume, the harder it becomes to separate strong opportunities from weak ones. Eventually, everything starts looking tradable,